Hi everyone, Adrian here. In this video we're going to be talking about borrowing power. What's been happening in the last kind of 12 to 18 months with the 12 rate increases, and you just can't escape it. It's in the media, it's online, it's in the news, it's on the TV, it's on the radio. Everyone's talking about the rate increases. Everyone's talking about a housing crisis. Everyone's talking about how no one can borrow. And to borrow right now compared to, let's say, when rates were 2 or 3%, across the board, borrowing power has gone down, if not 30, if not 40% in total, because you had rate ranges of 2 to 3%. Now you're looking at rate ranges for the prime loans anywhere in the high 5s to the high 6s at the moment. All right, and then obviously it goes up from there for the second and the third tier loans. All right, so let's see some of these articles that we're having a look at here. All right, we've got borrowing power. We've got rate rises slash borrowing power by over 200K. It was an article done by the Tribune on March of 2023. Everyone's trying to find these simple little hacks with increasing their borrowing power, and people have been talking about how HEX has been affecting borrowing power. So HEX is when you take out a loan for your study. All right, now what's this other one? Mortgage Professional, February rate hike will cut the borrowing power by 143,000. Rate City, shrinking borrowing power, home buyers borrowing $126,000 less than 2020. Okay, and what's actually happening, which is a converse relationship, is that anyone that's a developer right now that's either developing land or they're doing homes, they're doing villas, townhouses or units, have seen an increase in their cost base upwards of probably 20 to 30% since inflation started. So your standard build that used to cost for a 2-bed granny flat, let's talk about that, used to be anywhere from, if you've got good finishes and fittings and it looks like a nice 2-bed granny flat, used to be anywhere between say 140 to say 165. Now you're looking at 180 to say 205, depending on driveway and a couple of other things. All right, so we're seeing this across the board, and let's talk about me personally. So I was at the end of last year, I was blocked on my borrowing power, and I've been very open and honest about talking about how I've fixed it and how I've gone about it. And that's essentially by scouring through 50 plus lenders in the country. Not only that, me and my mentor tore everything apart. So we contacted every bank and asked them about corporate trusts and how they used and how their policy was. Then when we contacted the current banks, half of the BDMs didn't even know their own niche products. So we had to go internally into the banks, use all of our contacts and find the most experienced team, which took 2, 3 or 4 months. We found 12 banks that do corporate trusts. And then not just that, the problem was that the rates have gone up through the roof. So if you go ahead and you try and use corporate trust to increase your borrowing power, a lot of the current strategies won't allow you to do it because the lender needs to say that each trust is profitable. Okay, and even if you're buying 7% yield in northeast Queensland with a low purchase price, after you account for all the costs, you're still not cash flow positive, so the accountant won't sign off. So you're either having to do mixtures of high yield units, 9 and 10%, to even have a chance of each trust being profitable, or you're having to put huge deposits down, which lowers the debt, which allows you to have an asset that's yielding a little bit less. All right, so that's where a lot of people are. So it's pretty common why we're doing, buying investment properties with granny flats on the back, because if we do the construction loan at the same time that we do the buy, then the accountant knows that the granny flat is going on within say 4 to 6 months of the buy, and they know that the trust is profitable. You show them the construction contract and then they'll go ahead and sign off. All right, and just bear in mind that this isn't advice, because I'm actually going through this personally. So this is a personal story that I'm telling you that we've had to go down to get to the point that we're at. So we've got all these clients right now that are sitting in a DTI range of somewhere between 5 and 7. Okay, and DTI is very simple. It's debt to income ratio. All right, so add up your income, add up your rent, times it by 6. You're pretty much maxed at the moment. Now the problem is when rates start coming down, and you're in a position where the DTIs start getting back in your favor. Let's say we see 3 to 4 rate drops. You could be in a position where, you know, suddenly you could go from a 6 to a 6.5, but that still hasn't solved your issue because you need room in the DTI for the next buy. If you don't have room, you're still capped. So you got a lot of these people that think if they can wait for the rates to drop 3, 4, 5 rate cuts, that they're going to be in a position to buy a lot more. When in reality, if they don't go into structures and they don't talk to the right accountant and they don't use the right property strategy, they're only saving, say, another 6 to 12 months to get to a situation where they're going to buy one more and then that's it. So, you know, you're in a situation where you're just buying one more asset, which is completely fine if that matches your goals and what you need and what you want to do with your retirement, and if you want to retire early, or if you've got a family and one of you wants to stay at home with the kids. That one property may get you there, but a lot of people are telling me that they don't want the one property. They want 3, 4, 5, 6, 7, 8, 9, 10, or they want to do their 10 and 15 year goals in 3 to 5 years, and there's no way to do that. Even if you go ahead and you do all of the tweaks that these other brokers are telling you, so you reduce your credit cards, close off your personal loans, pay your HECS out, okay, go to a lender that's got a better policy, you know, self-employed. You could have had a lower second year but a higher first year for a company person. So you could potentially go to a lender that isolates that first year. So you can have some lenders that enable you to, you know, borrow a lot more policy-wise. But we're only talking, like, normally if you're talking about these small changes to structure, or bumping loan terms back from, say, 22 years to 30 years and things like that, or going to a lender that's going to use more bonus or more overtime. Most of the time that's getting you, you know, a 100 or 200 grand increase in your borrowing power. Or some of the bigger ones like I talked about with the self-employed, you might be getting, you know, one more property out, maybe 2 max. But you're never going to be in a position where you're uncapped or you're unlimited. All right, and me personally, that's exactly what I'm doing right now. So I've got the deposits sitting in my account. I've refinanced. I've got 2 cash outs that I've done. I've got another portion of money that I've got access to at the moment. And I'm buying 3 more at the moment. So I've got to do it a little bit slower because they're in corporate trusts. All right, so I've gone through the last 18 months, I've outgrown my accountant 3 times. I've had to go online, search, speak all to my network and find out an accountant that's not only doing exactly what I'm doing, you know, but they're also doing they've got 500 plus other clients doing corporate trust investments. They've got all these clients that are fully income replaced, that are going in the development space or doing commercial or doing micro units or doing duplexes a year flips or starting into development. And you know, they're not just your bread and butter 1, 2, 3, 4 investment property clients. So I can say hand on heart, the accountant I found will be good even when I get up to 20 to 30 properties, which I'm not far away from. All right, so one, you know, even if you found out the 12 lenders that have the right policy for corporate trusts, 2, even if you went to the BDMs of half of those banks, you wouldn't be able to run with the policy or get the information because it took us very long. 3, even if you found those banks and that the ones in the team that will actually do do the right thing via their policy, which most of the other assessors and the BDMs don't know what they're doing, you don't have the right accountant. So as soon as they ask for the letter, they send it to the accountant. The accountant is going to cause a problem. Most do. Most won't sign off, or they're going to ask for word changes, which the lenders don't accept. And then three, most of the time, if you don't link this up with the right property strategy, there's no point anyway. I mean, you're not going to be using this strategy for buying 1-bedroom units in Bondi. It's just, each trust isn't profitable then. Even if you do pigeon pairing, where you have one, say, 10% yield unit, and then you pair it together with another unit that's 500 grand more, that's on a 3% yield, pigeon pairing in the same trust can still not get you to a trust that's profitable, so the accountant won't sign off. And if they are signing off under the current arrangements, they're either dodgy or they're doing something wrong, okay? And they're putting you in a position where there is much more risk than anything that's allowed under the current, which is why I'm so stringent and why I'm so careful on the accountants that I deal with and the advice that I get from those accountants and the strategy that we use with those accountants. And we do like doing 20% deposits. We don't like doing 10% deposits. And we don't just like the yield associated with houses and granny flats. We like the fact that there's 2 rents coming in as opposed to 1 inside of one trust. And normally if you've got, let's say you've got a goal of 20 properties, most of the time you'd set up 10 trusts. So you'd put the first 10 in 10 separate corporate trusts, and then 11 would go onto 1 and 12 would go onto 2. So you'd stack 2 per trust. So then you're getting 1 land tax threshold per trust. And if you've got 2 properties per trust, most of the time you're not going over the land tax threshold, but then you've suddenly got 4 rents coming in per trust, which is lower risk overall. All right, so this is just what's happening to me personally. This is just an overall video that we're doing on borrowing power. Really, if you've just got a broker that's talking about adding up your loan size by an extra 150 grand, it's really only going to get you maybe 1 higher property or maybe one property that's 100 or 200 grand more, or potentially just getting you to the next property, but then you're capped. So anyone out there that's wanting to look at structures like I'm doing right now personally, that my mentor has guided over 100 clients to income replacement. I've been in the investment space for over 3 years now. I've guided a lot of people through this as well. I'm going through this personally myself, okay, and I've been in finance for 14 years. So if anyone thinks that this video has a lot of value, hit that like button, hit that comment button, hit subscribe, and we'll see you on the next video. All right then, bye.